Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Neno Raic, partner at NLC. Neno, it's great to see you again. Thank you for your time, obviously for your support at our Fund Finance Conference. How are you doing? And looking forward to the episode today.
Yeah, likewise. Thanks for having me.
So, just to kind of start off at a relatively high level, when we were at the Fund Finance Conference back in June, which feels like a long time ago at this point, you guys had done a workshop called Sublines 2.0. Kind of what has the evolution of Sublines looked like from 1.0 to, kind of where it is today, 2.0?
Yeah, no, absolutely. I think maybe even before answering that question, like taking a bit of a step back about us as a firm and NLC, we obviously alternative lender. We focus exclusively on fund finance, and subline financing is a core market that we participate in. What we have observed over the last kind of 3 to 4 years has been quite a significant shift in the market in general. And the kind of main thing that we've seen is sublines. I mean, fund finance in general has kind of made a big step forward. But we've seen the most of that evolution or innovation happening within the within the subline space, which is the kind of most mature part of the market, and the market that have seen the least amount of evolution over the course of the last 10 to 15 years. And what do we mean by that? I think one thing that has certainly changed is how GPs are utilizing these facilities. They're no longer viewed as just a short-term bridge during the investment period of the fund. It's much more of a strategic, very cost-effective leverage tool at the fund level. So the deals that we have certainly participated in or seen in the market range anywhere from kind of very vanilla new fund. You're setting up your RCF to kind of support and bridge the new investments, all the way to a lot more structured solution, even towards the end of the fund life or beyond, which took a form of a subline or a capital call, effectively just meaning secured by the undrawn commitment. So that part of the market shifted quite a bit, and certainly, I'm sure we're going to touch on some of those developments. The other side has been obviously on the lending and funding aspect of it. Banks are obviously a big part of our market and continue to be, but how those banks are funding themselves and everything that is happening there has moved quite considerably. And some of the points in terms of developments that we see, like the term loans and tranche Bs, and a lot of these things are, if we had this conversation probably 2, 3, certainly 3 years ago, it would be a very different environment than the one that we operate in today. So that's why we kind of called it 2.0. It's super exciting to be part of this market. Again, we don't maybe do this as often, but kind of driving a lot of those changes through our offering and creating value to the GPs and the rest of and our investors has been something that's been quite rewarding for us over this period of time. But that's kind of the main summary, shall I say, in terms of what do we mean when we say 2.0, and how the market has been reacting to that.
So you referenced obviously term loans and tranche B loans. Can you talk a little bit more about the growth of term loans? And when you say term loan, what does that mean in the context of sublines?
Yeah, absolutely. I mean, the sublines historically and still to this day, though, are predominantly revolving credit facilities. I mean, when we started this business 4 years ago now, there was no term loans in the space, or they were far and few behind. Like if you ask anyone now, pretty much all large GPs utilize term loan structure, and that's something that we have been able to push. We have strategically made a decision where we were kind of offering the solution to the GPs that we are going to push and share as much as possible around the structuring and know-how of this type of product. We're a firm believer that this creates tremendous amount of value for GPs, but also for all other market participants. And it took a little bit of time, but today, sitting where we are, amount of term loans that we're seeing in subline space is, I mean, you would almost, even all new facilities that are being set up, day one include capabilities to start terming out some of the sublines. And that's something that was certainly not the case 4 years ago, and kind of leading that effort and kind of being that pivotal entity in that journey for a lot of these large cap managers, and the trust that they put in us, like for some of these, the largest alternative managers, the first time they ever utilized term loans, they kind of went with NLC, and that's been something that's been particularly exciting to see. So that's kind of what we see. It's now used almost as often as RCF. The RCFs are still a bigger part of the market, but it really depends on what type of situation the fund is and what the GP is looking to achieve, if they're going to go with RCF with term loan, which is, again, quite exciting to see more tools being developed in the market and utilized by market participants, effectively making the whole space much more efficient.
The other thing you mentioned, obviously, was the emergence of tranche B loans, which is a relatively new development. How much adoption have you seen, and kind of what is the value of these new structures that's delivering the value to GPs?
Yeah, I think the tranche Bs are they have been around for a bit of time, but not used as much. Some of the market dynamics certainly help promote it. Obviously, in the environment that we are in or have been in for the last couple of years, we see things shifting a bit, where the exits have been a bit more subdued. Like finding a way to keep your subline facility outstanding for longer was something that was quite relevant to GPs. Again, calling down capital to repay your subline, with the pressures that the market has experienced around DPIs, has been something that was not necessarily the best way to manage your fund. So kind of trying to maximize the advance rate that you can get from your borrowing base has been something that the GPs have turned their focus to, should we put it that way. Obviously, particularly for the large GPs, when you need a large subline, you will have a number of bank lenders that will have different policies and procedures, and at times you can have quite a strong quality LP base, but you'll be restricted by some arbitrary policy points in terms of how much you can borrow. And that's where we've seen these tranche Bs being super effective tool, and a strategy that we like quite a bit, because you can offer that additional capacity to the borrower to either keep the facility outstanding for longer or to make a bolt-on acquisition. It's done at quite an attractive cost compared to some other alternatives that will be such as NAV lending and other things. So we have seen quite a bit of an uptick in terms of use of those facilities. And the one that we think, again, it's quite a net positive for the market. We don't necessarily see them being used to increase the fund leverage. It's more to kind of optimize the existing subline and keep it outstanding by flipping the part of it to tranche B, so that effectively they don't have to repay it by calling down capital. That's been the big part of the change that we see in the market. And then to your point around the volumes, we've seen a lot more. Certainly this year and last year, we've seen a big pickup compared to kind of where this market was a handful of years ago.
What about the use of securitization, structured credit technology? I think we've seen at least one publicly done deal. I think it was sometime last year. I'm sure there's been other private transactions that have taken place. Kind of, how do you see securitization playing a bigger role in the subline space? And what do you guys think about those opportunities?
Yeah, I think kind of there were two things, and we obviously spoke about this on the panel. So you had there are two approaches that emerged in the market. One was around ICG, and they effectively took a subline and did that in a securitization format. The main driver for that was from the bank providing the line. They were able to book it as a securitization and get a capital benefit. That structure. There are certain benefits, pricing benefits for the borrower, but there are some operational complexities that come with it. We don't necessarily see that kind of, or while we see more GPs utilizing that solution, we don't think that's going to be as revolutionary. One more interesting aspect of the securitization has been with some of the banks securitizing their subline books. This has been something that everybody's been talking about for a while, but then GS has done two to date. We think that's super welcome development of the market. It further institutionalizes this space and introduces new sources of capital. The dynamic of it is quite interesting. And what do we mean by that? Where you go from these facilities historically always been done by banks, funded by banks' balance sheets. The pricing dynamic we think will change. And what exactly that means is we don't think that actual pricing is going to change as much, but certainly the correlation to some of the other markets will increase, which historically has not been the case for fund finance, particularly subline financing. The banks were holding most of these loans on balance sheet. They were doing them from a relation perspective to get deeper with the sponsors. Now, with these distribution angles and securitization being one of it, there's a lot more consideration when it comes to price and kind of the potential changes in the pricing that we can see in the subline market.
What are some of the other trends you're seeing in GP behavior today, and how do you guys think about kind of that, smaller manager versus some of the large managers, and is there kind of a bifurcation taking place in the market?
Yeah, so we definitely see interesting developments. I think the biggest one that we have observed over the last couple of years has been increased sophistication and recognition of fund financing as a tool. So obviously funds in general are very sophisticated, but the way they were considering fund finance previously were quite kind of rigid. You have your subline and then you would have your nav line. Now the lines are a lot more blurred. GPs are considering how they can best optimize the fund debt, and this is going from a revolving subline to term subline to a hybrid solution or a potential NAV solution. And these are some of the changes that we have certainly observed. The other thing that we have seen is increase dedication of resourcing to fund financing within the GPs. Again, the market has shifted a little bit where historically this would sit within either Treasury or CFO office to now increasingly having dedicated teams. And that's absolutely necessary if you're trying to obtain the best kind of terms from the market and utilize the most products that are available out there. So when it comes to then bifurcation between large managers and smaller managers, it's an interesting dynamic. One thing that's different now than historically is the rating aspect, and the size of the manager can have quite a significant impact on that rating outcome on that particular fund. So to the extent that the bank is distributing that paper, that's something that will influence pricing, as well as to the extent that they're using securitizations or others to do that. So that's one aspect. Historically, you would see, I wouldn't say necessarily funds below $1 billion, but around that $1 billion mark, have access to better pricing because a single bank would be able to provide a bilateral transaction, and for a number of reasons, they might be more motivated to bank that particular client to source all ancillary income.
Yeah.
We still see that, but the large cap managers, because of the institutional markets, the pricing is coming closer. And again, historically, you will have this kind of lowest or highest common denominator. If you need a 3 billion subline, it's a revolver. You have to price it to whatever the clearing price is, and you might have some banks at a lower or higher level. But that was one of the dynamic that we are certainly seeing reducing, if that's maybe the right way to put it. And why is that? Because the institutional capital is coming in and taking a part of some of those, let's say, more expensive bank role in some of the historical larger syndicates.
It's a good lead into my next question because, you do come from a banking background. You guys started NLC, kind of how is or where is the market today with kind of that non-bank bank, lender? How much interaction or collaborations between the two? Is one playing in a certain area of the market, or is it kind of depending on what the manager needs are and what they're looking to optimize? Kind of how is the dynamic playing out between bank and non-bank?
I think there's tremendous amount of collaboration, and that's something that's super exciting for us. I think each brings unique set of skill set to the table. And one thing that we are particularly focused around is always around value creation. So how can we create value for the borrowers, for our investors? And we think that partnership between bank capital and non-bank capital or institutional capital is very complementary. And there were a number of partnerships that were publicly announced as well, in terms of increasing presence of non-bank lenders in this space. And we certainly welcome that and find that super exciting. We think ultimately benefits all market participants. It further sophisticates the market itself, but then again, it kind of makes a big leap forward, especially if we consider where this market will be in a couple of years and the growth trajectory that's there. That part of it is quite exciting. The regulatory side of a bank, again, we've been kind of now doing this for 4 years and change. Haven't been involved in it as much. Obviously, the new administration has made some changes which have had an impact for the banking capital. Fund finance, in particular, subline financing is and will continue to be bank-dominated product. So any changes in a regulatory framework will have, in our view, significant impact on how the market will perform and behave. We have certainly seen that couple of years ago when Citi stepped away from this space and kind of the US regional crisis and all these other things. So it remains to be seen where we currently stand. It feels like everything has been put on hold, but we think inevitably the trajectory is more regulation to banks, and as such, finding right solutions or partners to work together with to find alternative sources of capital is something that we think can be quite accretive to banks in this space as they kind of continue to assess how they deploy the capital to support the GPs in this space.
You guys, I think have recently just launched, I think fairly recently, your new NAV lending strategy. Kind of what was the thinking behind this move? Where are you focusing your efforts? Kind of tell us a little bit more about the jump into, the NAV lending strategy.
Yeah. So we just announced it, but it's been something that we were planning for a very long time. And the question was not if, the question was when, and truly how. The reason why it made so much sense for us, and maybe to jump into what exactly credit NAV is for us, we are, and honestly, we are fund finance shop, and we are investment grade fund finance shop, and the kind of the ABL or credit NAV space where you're kind of underwriting cash flows is something that certainly we have some background in, but we knew that was the natural next step it really complements the offering that we can provide to our investors. In addition to sublines, you have a strategy that's a little bit longer in duration. You still have very diversified pool of underlying assets. You're underwriting cash flow. So from that perspective, it was quite a logical next step. And that's where we want to continue to build our franchise, given all success we have had with our subline strategy, the GPs, and kind of the reach we have there. We wanted to be able to offer those GPs more and serve them throughout the life cycle. And this is really what the Credit NAV was all about. What we have found setting up this business and growing the franchise and kind of innovating and disrupting, to be honest, some of the traditional subline market is, in order to make a considerable inroad in the existing markets, you need to have a focus and dedication. And as such, we did not want to make such a commitment to enter this space until we found the right team to do that. I feel extremely lucky and privileged to be working with people that I am. I think they're absolutely exceptional. And certainly with Credit NAV, there's a lot of professionals out there that are very good at that. What set apart team with Steve Berry and Roger Fox is they have not only come from that background as part of the banks, and I know Steve for many years at Investday, but they have set up this platform before at an asset manager, and they made it a success. And that was what made a clear differentiator for us when we were considering, okay, how we enter this market. We wanted to have a team, but having the team that has done it before, has done it successfully, and kind of combining it with the platform that we have built today, just made it really a non-brainer. So when there was an opportunity to get Steve and Roger, we jumped at it, and we're very excited and privileged to have them part of the team, and we're very excited what the future will hold. But in general, we see a big opportunity, again, to create value both for GPs and for our investors by positioning the business to be able to serve Credit NAV facilities.
So, one area of NAV that has certainly been a bit more, I guess, controversial, you could say, is, the LP view of NAV. And I had ILPA on a couple months back, and I know they're more private equity than private debt, but there is still a fairly negative feeling amongst the LPs in the on NAV facilities, and kind of a lot of that's around transparency and use of the proceeds of NAV. And kind of how do you help change that education gap? Do you see that as a potential barrier in the growth in the space? What are your thoughts around kind of the LP, I guess, view of NAV as it is today?
So that part of the market, or kind of, and that's one of the things that I find quite interesting. NAV means a lot of things to many people, but in reality, NAV is a lot more complex. And I think when you look at kind of Credit NAV and then ABL, that market has been around for quite some time. Private debt manager utilizing that to provide levered returns is not only something that's very known to the LPs, but often required by the LPs. So when we speak about some of the more recent points that have been coming from just in general market, I think those have been much more focused on private equity NAV, which is not something that necessarily we are active in, but it's also much newer, and the characteristic of private equity NAV versus Credit NAV, certainly in our view, are quite different. For Credit NAV, you'll be underwriting the cash flow and the underlying loans. You're not underwriting exit events, and you're not bridging to exit, which is what private equity NAV tends to be. So don't want to comment the views from the market. I think a lot of things that have been said are not particularly fair, and I think the GPs are very sophisticated in terms of how they're utilizing these facilities, and ultimately they are being used to create additional values to the LPs. But that being said, I am a big proponent of transparency in any way, shape, or form. Certainly the way we run our platform with our investors is being fully transparent, and I think that can only be good. And so having transparency and sharing that's something that's from my perspective, you can never have too much of. So that will be one of the things I think maybe as one of the observations as an industry, we could have done a little bit of a better job articulating to the market really what this is, because kind of these titles or things that come on leverage on
It's gotten certainly a bad rap based on some articles and some
I
thoughts,
don't
and I
think
think that's kind of why I brought it up. I wanted to hear your thoughts on kind of that misnomer around it.
I don't think it's fair, and I think again as an industry we probably should have done a better job kind of articulating how these facilities work and what they are and the distinction between them and how and why GPs utilize this. But it does feel like it's getting in the right direction, and anything that new will have some sort of pushback, and we certainly experienced a fair bit of that share with the term strategy that we've been doing with Subline. So nothing unusual there.
So you guys have obviously expanded into the U.S., opened a U.S. office. What is some of the thinking behind the bigger push into the U.S.? Is it more of a natural evolution of the business as you grow and scale? Is there a particular opportunity that's like, hey, we think we can kind of carve out something in the U.S. and then expand from there? What's kind of some of the motivations behind, at least doubling down on the U.S. strategy?
Yeah, I think probably the best way to describe us is we're a US firm headquartered in London. And the reason why I say that is most of our facilities are in dollars, most of our borrowers are US based. Private capital in general is just such a US dominated space of 60 to 70% is US. So US was always an area that we were active in, and we have made many trips over the course of these years in US. But having boots on the ground was something that was, again, always very high on the priority list of the business. We have tried finding people on the ground that we can kind of bring into the business, but we found it, while the talent pool was very strong and very exciting, we were always very mindful of NLC culture and kind of the values that we bring forward. And we ultimately concluded that the best way for us to build out our New York or US presence was for one of the partners to come and really set that up. And Slade is moving in US. The move should take place next month. It took us a little bit of time to do all the operational side of it, but it's something that we are very excited about, particularly given that fund finance is a relationship business, and having boots on the ground is something that's super important. So we're very excited about the future and scaling that office and hiring new professionals to help us further establish our US brand presence and continue to grow the book.
We got a couple more questions before we get to the fun questions and then wrap up. What investor or LP expectations, kind of how are they changing within the fund finance space?
I think I can answer this question probably with a bit more background than most. And I have had the pleasure or the curse, whatever you want to call it, of institutionalizing this space. When we were starting to approach investors about fund finance, this is about 8-9 years ago, nobody knew what it was. Forget about now, forget about Subline. It was absolutely new, and we had this vision that this is the market, and this asset class is going to should create a lot of values to those LPs. So we stayed committed and we pushed on, and we were able to bring rating agency along that journey. And when you look at now what fund finance is, it's probably one of my personal proudest achievements. It's an asset class that creates so much value. It offers great relative value for these investors, and seeing number of institutional investors involved within fund finance in one shape or form, the insurance companies making a big strides in our market is something that's absolutely spectacular, and I think we will see more of. And the reason for that is just private capital in general is growing as such. the lending to private capital space is growing. Private investment grade as an asset class is something that's super exciting and interesting for a lot of investors without going into all the, well, let's call it fun part about regulatory environment for a number of insurance and pension funds in different jurisdictions. Private IG is something that will continue to grow. And when it comes to private IG, our view is that fund finance offers very unique and very attractive risk-adjusted returns in relatively uncorrelated or on relatively uncorrelated basis. So we just expect to see more and more of it, would be the way to put it.
So in a lot of recent meetings we've had, there's been a bunch of, I guess, bleeding edge or next level topics that have constantly come up, secondaries, continuation vehicles, interval funds. I mean, some of this might not be where you guys are focused, obviously, but what, innovation or maybe what next step is most exciting or most interesting in the evolution of fund finance for you?
Yeah, so some of those that you mentioned, we are already active. So continuation vehicles will provide financing to those. Secondaries, we are active in. So secondary NAV lending is something that we do. That's kind of our forte or our strengths, either looking at undrawn commitments in the case of a continuation vehicle, or when it comes to NAV lending is really underwriting the cash flows. That's where we can bring, in our view, quite a lot of value with the firepower that we have, and we are quite uniquely positioned compared to the rest of the market on that side. When it comes to future developments, our biggest excitement is just kind of the continued growth of the market and all the innovation that's going to come out of it. We see fund finance not necessarily as sublines, NAVs, and kind of everything in between. We think that fund finance is truly that, and then your collateral pool will depend on specific needs and what the GP is looking to achieve at that point in time. And the key point is to provide our investors access to the full set of those opportunities. And yes, there's some investors that are focused more or exclusively on a certain parts of that market because the capital that they're utilizing is kind of part of a particular bucket. But that would be maybe our observation, or kind of as we think of the future of this space, that's the most exciting part. And then the second part is if we look at this, and there was one of my ex-colleagues who said this, and I could not agree more. You look at kind of subline financing for the last 10, 15 years, you had absolutely no innovation. It was just such a standard product. And then over the course of the last 24 months, you had so much innovation. Some of the points that we touched on, that it's just exciting to be part of it and continue to find right opportunities to deploy our investors' capital and support the GPs to unlock more value for them.
On to the fun questions, as we have a couple minutes left here. Do you have a favorite sports team and or hobby?
And or hobby, yeah. Favorite sports team, nobody will know unless you're Croatian. It's Hajduk Split. It's a bit of a it's a sad thing, as we haven't won a championship for many years, over 20 years. So it's been a long time since I witnessed that. But that's the team I follow and support religiously. So every weekend you're going to see me watching that, and people is like, "What is that?" And I'm like, "Let's not even go into that." Hobby, everything that you would expect from someone working in finance. So golf obviously takes a big part of that. But tennis, paddle, all that stuff.
What's your handicap in golf?
Do I need to say publicly? I don't know how many listeners, or probably most of the people dropped off by now. But I'm in 20s. So
Okay, that's pretty good.
Yeah, I think pretty good would be a stretch, but it's okay. I could get around.
What's one book that you would recommend reading?
There's just so many. It depends. I can tell you one book that was probably quite meaningful to me, and this was more around the time that I picked it up, which was just before we were starting NLC, and there was the book that Steven Schwartzman wrote about what he takes on Blackstone and the journey of that. I enjoyed just biographies and autobiographies in general, and particularly when it comes to quite influential and accomplished people. But for me, at the point of time that I was in my career, reading that book had a big influence, and was quite instrumental in getting the courage to launch NLC. So that's maybe the one that I would recommend, but it really depends what you're into.
One surprising thing about yourself.
I don't know if there is any, I'm not gonna lie. I think it's everything is what you would expect. I mean, I just told you I play golf, I work in finance, like it's very
I'll switch up the last question. What made you ultimately say, all right, let's start NLC? Because it's an entrepreneurial journey. It doesn't, come on easy. Kind of what was the impetus to say, hey, we need, me, my co-founders, we should do this?
Yeah, that's an interesting question, because in hindsight, and this is again one of the things that comes in Steven's book, not that we are anywhere close to that journey, but it's like you look at it, and at the time it didn't feel as risky. We were doing this business and Investec. I felt that there were things that we could do differently, that we can do better, that we can, and again, I'm going back always to this value point, that we can create value for the market and value for our investors. I think that's kind of the thing. As long as you create value and have strong and established processes, other things fall in place. So as we were kind of considering making the move, we truly challenge ourselves. Do we think we can create value for the market? And then do we think that we have the right skill set to establish processes to allow us to be successful? And once that became an obvious answer to yes, then the move felt quite obvious. Again, looking from this position now and the growth we had and kind of pioneering and leading the term loan space. I mean, we are by a significant margin the largest term lender. We have done the biggest term loan in subline space. We've done 1.8 billion on a single ticket. Like the number of things that we have been able to achieve. So looking back where we started, yeah, it looks a lot more risky at the time, but those things were they just made sense. And then the support from my girlfriend and just made it such an easier decision than necessarily would have without that. So those would be probably the two main things.
Well, Neno, I think that's a good place to end. Thank you, as always, for your time, for your continued support of our fund finance events, and look forward to catching up again soon. Continued success to you, Slade, and the entire team.
Fantastic. Thanks, Todd. Much appreciated, and always happy to support such a great organization and market. What you're doing for the market as we kind of open up the discussion. I think it's fascinating, and well done to you as well. So thank you for having me.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.